Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Forte Biosciences stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Forte Biosciences is a biopharmaceutical company focusing on the treatment of the inflammatory skin disease atopic dermatitis, also known as eczema. The product it is working on is called FB401, which helps atopic dermatitis by improving tissue repair and anti-inflammation, as well as suppressing potentially harmful bacteria. Atopic dermatitis is a condition that makes your skin red and itchy. It is common in children but can occur at any age. It is long-lasting and tends to flare periodically. It may be accompanied by asthma or hay fever. No cure has been found. 2 months ago, the company reported that FB401 failed to meet the primary goal of its phase 2 clinical trial. The company has decided to discontinue the further development of FB401. They do not have any other drugs in their pipeline. The company's website has not indicated if they will start working on other drugs or sell the business. It has 7 patents, so those patents may be valuable to other companies researching eczema. The company is headquartered in Torrance, California, and was founded in 2007. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a micro-cap company, 38 million market cap. They're trading at $271 a share, and they have 14 million shares outstanding. Let's look at the financials. Their free cash flow is negative. Free cash flow is cash flow from operations minus capital expenditures. Since they're pre-revenue, they have negative free cash flow and negative net income. Net income is the profit or loss on the income statement. It's revenue minus expenses. This is the company's income statement. The top line is the revenue, the sales. Most of the income statement is operating expenses, and a bulk of their operating expenses are research and development. Part of research and development is payroll, how much you pay the employees to conduct the research and development. Also, depreciation, amortization, the cost of equipment, and the cost of the facilities. So of course they have negative operating income. They don't have any debt, so there's no interest they pay in their debt, and they have negative net income every single year. This is their 2020 income statement from their 10K. So they had 10 million in R&D, 4 million in G&A. G&A is payroll, rent, insurance, things like that. And they had 32 million of IPRD, in-process research and development. When they acquire another company, they take on their research and development. So if you see in-process research and development, that's from when a company acquires another company. IPR&D is usually capitalized. It's put onto the balance sheet, and then it's tested for impairment annually. But they put their IP R&D straight to the income statement. They expensed it, all 32 million. When a company internally generates R&D, that's expensed as incurred. It's put directly onto the income statement. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company lost from its operational business. And they only spent $162,000 in CapEx. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow each year, they're running their business on equity. They issue stock every year to fund their operations. They issued 5 million in 2019, 67 million, and 43 million. When a company issues stock, it dilutes the current shareholders. It makes your shares less valuable. But it's better for a company like this to issue stock than debt, because when you issue debt, you have to pay the interest on your debt. And that's not a good idea when you're not bringing in any revenue. But when you issue stock, you don't have to pay a dividend. It's your option. So if a big company like Coca-Cola issued debt at 3%, it's fine because they have a lot of cash flow coming in. Debt is fine if you have cash flow coming in and the return on the debt is higher than the interest you're paying. So if they use that debt to acquire another business and that business gave them a 10% return on investment, that's a good use of debt since they're paying a 3% interest rate. But if they acquired a company that lost money, that's a bad use of debt. Debt is a much cheaper way to fund CapEx or to fund acquisitions than equity. This is the company's balance sheet, and it doesn't look so bad. They have 50 million of equity. They raised 112 million from selling their business, and they lost $62 million from running their business. So there's still a lot of cash remaining, $51 million of cash as of 6/30. Let's look at the capital structure. They have $50 million of equity and no debt, so they're 100% equity. Since the only drug this company had failed and it didn't get FDA approval, and it will never get FDA approval because the company has not indicated they're going to be developing other drugs. So there's no future cash flows to estimate. So an easy way to value this company is to take the net assets, total assets minus total liabilities, or the equity on the balance sheet. That's how you value a company. And they have $50 million of equity. And if you divide that by 14 million shares, their stock price is $3.54. They're trading at $2.71, so they're trading at a 24% discount. It's a buy according to the model. So why doesn't everybody just buy the stock if it's worth $3.54 and it's trading at $2.71? Well, first of all, the equity balance, the $50 million, is as of 6/30. We don't know the current equity balance. They had $20 million of cash in the third quarter of 2020. They did a capital raise that went up to $59 million. Then it dropped to $55 million, then $51 million. So they're burning about $4 or $5 million in cash per quarter. So let's say it went from $51 million to $46 million. It's still above the $38 million. So they have more cash than the company is worth. It doesn't happen often, but sometimes a company has more cash on its balance sheet than its market cap. This could happen if the company's burn rate is really high. Say, for example, they were spending $30 million per quarter. If that was the case, investors would know this $50 million should be $20 million as of 9/30. That's why the market cap is $38 million. But that's not the case. Their burn rate is about $5 million per quarter. So stocks that trade below cash value may be investment opportunities, which I think this is. But it may also signal troubles for the company. So that's for you to decide. Carl Icahn is a really successful investor. He finds companies that have lots of cash on their balance sheet. He buys up a lot of the stock, say 20%, and then he forces them to pay a dividend. When you own a lot of the stock, you have a lot more influence. And you don't invest in companies so they sit on cash. Because why would you give a company $1,000 so they can just put $1,000 in the bank account? You can do that. You want to invest in a company so they acquire other companies or build factories and make lots of products and give you a good return on your investment, 10% or higher. You don't want a 1% return by sitting on cash in a bank. Companies like Berkshire Hathaway sit on a lot of cash. So when there's a company that's looking to get acquired, they can buy them right away. It's much easier to acquire a company with cash than to have to raise capital. Because if you were selling your company, wouldn't you want to just take cash, then wait a month or two for someone to raise capital by issuing stock or going to the bank and trying to get a loan? It's much easier to get cash. But not many companies are as successful as Berkshire Hathaway. So if there's a company sitting on a lot of cash, investors start to question that. But this case is a little different. They got denied FDA approval and they have cash on their balance sheet. 5 analysts priced this stock and the average price target was $3.25. So you can see the stock has gotten crushed since it started trading. It's down over 90% the past 52 weeks. And the stock was never this high, over $200. When they merged with Tokagen, they did a 1-for-15 reverse stock split. So you can divide these numbers by 15 to get the actual stock price on those days. This is where the stock has been trading the last 2 months. So you can see on this day it opened here at about $30 and then it closed at $28. And then the following day it opened at about $5. It's hard to tell in this chart, but this is the open and close right here. This is all the selling activity. Lots of sell orders the following days. So there wasn't much trading activity before this. It's hard to tell. But look how big these lines are. The opening and close is still hard to tell because it's inside of this bar. But then after that, it separates. This is all the sell orders, and this is the open and close, around $3. But then it kept coming down. Now it's pretty much at its lowest point ever. The stock is down 93% in the past 52 weeks, while the S&P is up 39%. The 52-week low was 261, the high was 44. And the stock is trading below its 50-day and 200-day moving average. In the past 3 months, over 2 million shares were traded each day. But in the past 10 days, that's down to 670,000. Of the 14 million shares outstanding, 13 million are on float, 53% are held by institutions, and 12% of the shares on float are shorted. The company had 10 employees as of June 2021. I imagine they got rid of most of their employees. They're probably down to 1 or 2. If you invested $10,000 into this company in 2017, you'd be down to $129 today. That's a 99% loss. The CEO of the company sold 1 million shares at $4.35. This is right after they failed phase 2 clinical trials. On the same day, the CFO sold 25,000 shares. That's most of the CFO's total shares. It looks like the CEO still has a good amount of shares outstanding. You don't have to pay for Simply Wall Street to get the insider trading activity. You can get it directly from the source, where everybody gets it from, the SEC filings. You can go to the company's website or the SEC website and look for their 8K filings. Anytime an insider buys or sells stock in the company, they have to report an 8K. So this is from their website. On 9/7, the CFO sold 21,000 shares at $4.24, then 3,500 shares at $4.27. And they put a D here for disposed. If it was an A here, that means he would have bought the shares acquired. The CEO of the company sold 1 million shares at $4.34. So he got $4.3 million. So you might have lost 90% of your investment, but he got $4.3 million. I'm not saying he doesn't deserve it. He founded the company and he put a lot of time and money into it. The CEO is the biggest shareholder at 9%, then Fred Alger, BlackRock, Franklin Resources, and Perceptive Advisors. Let's look at their financial ratios. We can't look at the PE since they have negative net income. We can't look at the price of sales since they don't have sales. And their price to book is below 1 since they have so much cash on their balance sheet. They have a high current ratio and quick ratio. They only have 3 million of current liabilities. So their balance sheet is really solid. The big problem is they don't have any products in their pipeline. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 16 companies in the same industry as FBRX. Since they're pre-revenue, they don't really have good ratios. Their price to book and current ratio is a lot better than the average, but everything else is pretty weak. So to summarize, I have them trading at a 24% discount. But this is a really interesting situation. We're going to learn a lot from how this company develops. If you buy the stock, you're going to learn a lot more. But the company may start developing new drugs and you could 10, 20, 30 extra money. And there's not much downside because they have more cash on their balance sheet than their market cap. So you probably wouldn't lose your investment either. I ranked their free cash flow as 1 out of 10, their revenue 1 out of 10, and their ratio 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.